The broadcast is now starting. All attendees are in listen-only mode.
Okay, apparently I've been speaking to myself. Good morning, it's Elizabeth Ballerman. I am the Secretary-Treasurer of NUPGE and your moderator for this fifth and final in the webinar series for NUPGE pension activists. A couple of housekeeping items here. It's probably repetition for those who've been on previous webinars. We have 3 presentations. Each speaker will speak for 7 to 10 minutes. And when the presentations are complete, we'll have an opportunity for you to ask questions. You can type your questions into the control panel on the right-hand side of your screen as we go along. And please specify if you want to point them at a particular panelist. And at the end of the session, we'll put those to our panelists to answer. We've scheduled 45 minutes. We've got a little bit of leeway at the other end. And each panelist will speak for 7 to 10 minutes, after which we go to questions. The webinar is being recorded, and we will have the video available to share with our attendees and others afterwards. In the handout section of your webinar panel on the right-hand side, you will see that there are 3 handouts related to this webinar, and including the speaker bios. So the webinar series, this is the 5th and final, which we put together for our pension activists and to recognize the critical importance of us, of our members, in helping to protect good quality pension plans and encourage the investment of our plan assets in the best interest of plan members, beneficiaries, and our communities. So this webinar series was developed in cooperation with Shareholders Association for Research and Education, and our thanks to Cher and in particular to Tamara Herman, who's done the yeoman's work on this and is handling our technical issues today on the webinar. So on this webinar, which is Investing for Impact, pension fund investments have the potential to generate positive social and environmental outcomes alongside financial returns. From local efforts to create employment and housing affordability to meeting global targets set by the UN Sustainable Development Goals, pension funds are increasingly seeking added value. This webinar will explore the growing field of impact investing and its relevance for Canadian public sector pension plans. We're going to start with Sean Hatch of Hatch Law, who will provide a legal perspective for investing for impact. Next will be Tom Wolfe of Insight at Pacific Community Venture, and he'll give us an overview of pension funds' economically targeted investments in the United States. And finally, Garth Davis, Managing Partner of New Market Funds, will speak to the challenges and opportunities of economically targeted investments in Canada. So gentlemen, welcome and thank you. And before we carry on, we do acknowledge that we have a less than gender balanced panel, and that's not for lack of effort, we assure you, but with no disrespect to our 3 presenters, who I know will share their expertise with us. It is certainly evidence of the fact we still have a lot of work to be doing and in the pension field on gender parity. So let me introduce to you Sean Hatch, who has been providing legal advice to a wide variety of pension and benefit plan clients in BC since 1979. The scope of Sean's practice has included establishing new pensions and benefit plans, providing strategic advice to government and public utilities on transitioning to new governance models, acting as a special mediator to settle the terms of collectively bargained benefit arrangements, and providing advice on merger and acquisition transactions, providing ongoing support and advice to numerous boards of trustees. So without further ado, take it away, please, Sean.
Okay. Hello, thank you very much. So yes, with the 7 minutes I have, I'll try to do a high-level commentary on the PowerPoint that you see here. So if we could skip to the next slide. I've started with a bit of a definition of just exactly what impact investing is to some. There's many definitions out there. But the key thing I'd like you to note on this is there are 2 purposes to the investment. The first is to generate a measurable, beneficial social or environmental impact alongside a financial return. So it's important to keep that in mind. The theme of my talk today is that with the 2 purposes being intended, there is some legal risk, and there are some measures that a board should be taking if they want to embark on impact investing to try and manage those risks. So if I could see the next slide, please. The handout here gives you a bit of a profile of what impact investing looks like in Canada based on a 2016 report done by the Responsible Investment Association. It's really just for information purposes. I think the thing to note from the profile that's presented here is that a lot of the investors in this field are credit unions, fund managers, and foundations, and not such a big uptake by pension funds, and I think there's good reason for that. The asset classes that are typically found in this field include private debt, private equity, public equity, residential mortgages, impact buildings, and consumer loans. So if we can move on. Most of the investors apparently target competitive returns, and 96% who were surveyed in this report said the returns were met or exceeded. And that's good news for pension trustees who want to look at impact investing in a serious way, because the preservation of returns is critical. There are some impact investors who can afford to concede returns in order to maximize impact. But the fundamental premise I'm going to leave you with today is that pension trustees should not go there. They should not be conceding returns to maximize impact. Next slide, please. What you find in the report I referred to is that the investors do find that there are business risks with these type of investments, and they're laid out here on the slide for you. There's business model execution and management risk, financing risk, and market demand and competition. And 22% of the surveyed investors reported encountering significant risk events in this field. And I would suggest to you that's a reasonably high percentage of investments that did propose what has been termed significant risk. Next slide, please. So again, I mentioned the two purposes. Oh, sorry, if we could back up. Back up one slide, yeah. No, there's one miss there. There we are. Perfect. So again, this theme that there's two purposes to impact investing is again important in my thesis here. When you look at a pension trust, the purpose is to provide retirement income for members. That's the classic trust law analysis. And I'll suggest to you that many judges will come at this with that in mind if they're asked to look at a particular issue. So the challenge for pension trustees is, can that single purpose be reconciled with impact investing? And how does the fiduciary duty of pension trustees align with impact investing? And I think that's the exciting part of this whole discussion. This really is a new frontier, I think, for pension trustees to try and reconcile impact investing with that fundamental fiduciary duty. Just a quick check-in with where ESG is today. Basically, I think when you look at the publications put out by the Principles for Responsible Investment by the UN, it's pretty much considered mandatory for pension trustees to incorporate ESG factors into their investment decisions. And again, this is tied to managing risk and generating sustainable long-term returns. Next slide, please. And again, this document in particular that is referred to on this slide comes out and indicates that it really is considered mandatory that ESG is integrated into the investment making process. But again, on the basis that these factors play into the financial metrics, if you will. Next slide, please. So I think it's worthwhile talking a little bit about what is the difference between impact investing. It's not the same as responsible investing because we're trying to combine that ethical return with the financial return. So impact investing, no doubt, focuses on ESG themes, but it's not the holistic approach that looks to any factor material to investment performance. And it's this dual purpose that poses some legal risk. Next slide, please. If an investment ever goes wrong, the trustees are not going to be held accountable because it went wrong or returns are not as expected. But what will happen is the court will look at the policy behind the investment and the process that went into making that investment. And so it is critical to have sound policies and procedures in place. And of course, it goes without saying, a board should be able to demonstrate that they followed their policies and procedures with respect to any particular investment. Next slide, please. So with the PRI, they've now identified that it's emerging that the traditional risk return adjusted approach to investing is starting to expand to include a third dimension, which is looking at the real world impact of investments and what they do to our environment and our society. And I think as time goes by, this theme is going to mature and develop. And I would venture a guess that in a couple of years, presentations like this will be accepting impact investing as part of the toolkit of pension funds. But I think if I were to advise a board today, I still would be cautious. I think this is an emerging trend, and I think it's one that has to be handled carefully. And I'll speak to some ideas on how that might be done in the next slide or two. So if we could switch, go ahead to the next slide. Could I get the next slide, please?
Sorry, Sean, it seems to have frozen. Just bear with me for 1 second while I try to get this moving. Okay, we are back on.
Okay. So we'd want to go ahead a slide or two from there. Yeah, go ahead. In the interest of time, I think I'd go ahead a couple slides.
Okay, just tell me when to stop.
So these are, so here, right there. Perfect, Tamara. So if a board is to embrace impact investing, here are some things practical things I would suggest the board consider. First of all, have a look at the trust agreement and see if there's an opportunity to have it amended to affirm that fiduciary duty extends beyond the strictly financial benefits for stakeholders. But you have to realize you can't abrogate or contract out of statutory duties. In BC, for example, there are very pointed duties that trustees must fulfill under pension standards legislation. But I'll just quickly give you an example of where this comes into play. Speaking with the lawyer for the Canadian Cancer Foundation, and they, of course, wanted to avoid and exclude any investments in tobacco products. And so they went and actually amended their trust agreement to specifically provide for that kind of special consideration. So I think the trustees would be well advised to consider that as sort of the groundwork to launch an impact investing program. I mentioned process and policies earlier on. I think it's important to have clear statements in your statement of investment policies that ESG integration is embraced for sustainable returns on an evidence basis, that there is a global trend to participate in impact investing, that these factors are no longer too remote or immaterial, that the sustainability of our environment and our economy and our socio-political systems are necessary to have a field or a milieu in which pension plans can invest. And so really, I think what we're trying to say here is we're going to illustrate that impact investing is indeed part of financial metrics. It is indeed part of a risk-adjusted return approach to investing. And I would suggest that some of the sustainable development goals put out by the UN would serve as a good focus for a board in their investment policy. Next slide, please. Oh dear. Here we are, if we can get that slide up.
Sorry, my computer has suddenly decided to be very disobedient today. Not quite sure what's going on. We may have to just do it. Hopefully people can see it in, I know it's small, but it seems that when I put it on full screen, it freezes. So let's just do this.
Yeah, these are pretty well the final thoughts, and I know I'm running out of time. So what I would suggest is that boards do not concede returns for the sake of social impact, that there are a lot of PRI resources for asset owners to assist them in navigating this field, manage the investment and the legal risks by due diligence, and a relatively modest allocation. Again, I view this as somewhat of a new frontier for pension investments. You know, there are other investment entities out there that are more active, but I think I would urge a fairly modest allocation at this point in time, and target appropriate risk-adjusted investments aligned with an overall investment strategy with no detraction due to impact investing. In other words, embed it into your overall policy, and that way you're not isolating impact investments as sort of a one-off or an anomaly, but that they truly can be shown to be part of your overall investment strategy. Final thing I wanted to say, again, just the usual legal disclaimer. The idea here is to present awareness and discussion of current topics, and really nothing here should or can be relied upon as legal advice for a board. And I know the listeners know that, but for the sake of the record, I thought I should add this disclaimer. So I'll leave it there.
All right. Thank you very much, Sean. Really appreciate it. We extended time a little bit because of those technical difficulties, and appreciate that. That makes life a bit challenging. Next, we're going to go to Tom Wolfe, who is the Director of Pacific Community Ventures Research and Consulting Practice, PCB Insights, where he manages their consulting services and research projects. He provides analysis tools and strategies to prominent institutional investors, fund managers, and policymakers. Tom has also led PCB Insights work with CalPERS, that's the California Public Employee Retirement System, for the last 8 years, and co-authored PCB's studies on U.S. pension fund ETIs, the pursuit of financial return and social benefit, an examination of pension fund economically targeted investments. So as you can see, he's well positioned to help us understand these investments for our pension plans. So please take it away, Tom.
Great, thanks Elizabeth, and good to be with you all today virtually, and my apologies, I'm battling a bit of a cold, so you'll have to bear with my voice today, but I'm going to share a bit of our findings from the research that we've done on ETIs that Elizabeth referenced, and also just kind of our views on impact investing, given we do provide consulting services to different institutional investors and others who are engaged in impact investing. So first, kind of to ground us in terms of ETIs really are investments that can be made across asset classes in a variety of different kind of thematic areas. So that, for example, they could be made in worker-friendly affordable housing, in-state businesses, infrastructure, other projects, and all with the aim of risk-adjusted market rate returns while generating some form of ancillary social, environmental, and economic benefits. So to ground us a little bit on terminology, and I won't go too deep into the impact investment definition since we just discussed that, but the way that ETIs are defined in the US by the Department of Labor are they're investments that generate collateral benefits apart from the investment return to the employee benefit plan investor. And the key difference between an ETI and impact investment, while they look and feel the same oftentimes, is that for ETIs, risk-adjusted financial returns are the first and foremost goal. And oftentimes the impact or benefit is considered ancillary, secondary, or collateral. So you'll see that language used to describe ETIs. And this is all kind of purposeful. Pension funds are describing these investments in this way to really be mindful of their fiduciary duty in keeping the values of loyalty and prudence central to kind of that investment process. So the difference again being ETIs, the financial return is prioritized very much more over the impact, and for impact investments, impact and financial return are viewed as equal goals. So our research looked at over 100 ETIs by gathering data information from a variety of public sources that dated back all the way to the 1960s to present day. And so collectively, these ETIs represented approximately $86 billion in assets under management. And so our research looked at ETIs made by public pension funds, private Taft-Hartley funds, as well as a few private corporate pension funds. The majority of the data, though, does come from public pension funds, representing approximately 70% of the ETI that we had identified. And what we found in the research is that ETIs can focus both geographically as well as on a particular ancillary benefit or strategy. So the geography could be defined as small as a city, or it could be as wide as a state or even region. And so what you see on this chart is a depiction of the ETIs by strategy and the way that the numbers fell out when we compared the ETIs we had aggregated in the catalog. And you can see that underserved markets by far were the most heavily represented. And so this idea of investing in underserved markets is akin to pension funds thinking about investments in emerging markets, but rather kind of changing that terminology to focus on domestic emerging markets where there's market inefficiencies, capital gaps, or where there's kind of an identified need for that capital and there's a strong investment thesis. Following those, we saw a lot of ETIs focused on community development more broadly, real estate, as well as business financing. So that's a bit of background on just what we saw in the data related to ETIs. Size-wise for the ETIs, the median came out to be about 525 million, and these ETIs can range anywhere from 20 million to $17 billion. So a whole range of sizes. However, the majority where there was this information available around assets under management tended to fall between 100 and $500 million in AUM. And ETIs have continued over time amidst market downturns, even politicization of some ETIs in the 1980s and 1990s that created challenge, as well as changing guidance from the U.S. Department of Labor around how ETIs should be treated under ERISA, the Employee Retirement Income Security Act. So ETIs have continued over time. Now to turn to a couple real-world examples of ETIs that are currently in practice. The Wisconsin Private Debt Program, this was formed in 1983 by the State of Wisconsin Investment Board, focused on the fixed income strategy with outcomes targeting job creation and business assistance, all looking at kind of Wisconsin investments as well as other Midwest states. And this program has an interesting history in that it was born out of Wisconsin being an early adopter of private equity investing, then transitioning into a private debt strategy. And as part of that private debt strategy that was focused nationally, they identified a number of attractive opportunities in their own backyard in Wisconsin. And so the investment director at the time, Bob Zobel, found these opportunities to be quite attractive and then decided that there was sufficient number of opportunities in Wisconsin to turn this into a dedicated program. So within the program, while there's no set allocation, it hovers around $300 to $400 million in size in any given year. And the capital that they provide is generally long-term, 8 to 9 years, fixed rate senior debt investments, but they also do provide mezzanine debt investments. And the deals range between $10 to $15 million. And again, they're looking for investees that are headquartered in Wisconsin, operating in Wisconsin, or intending to invest in Wisconsin. Regarding performance, approximately 85% of the capital of this program is invested in the state of Wisconsin. And as of September 30th, 2016, the private debt program's annualized one-year return was 10% versus a benchmark of 8.1%, and the 10-year return was 8.3% versus 6.4%. So the program has been pleased with the returns that it's managed to deliver for pension holders. Next, turning to another example, this one from the AFLCIO, their Housing Investment Trust, formed around the same time as the Wisconsin Private Debt Program, also fixed income, but rather this one's focused on housing and supporting union jobs. And it's not geographically restrained, rather is investing nationally. But this program is one in which it's an open-end mutual fund, and the AFLCIO is seeking investment from eligible pension funds and labor organizations with a minimum investment amount of $50,000. And so the AFLCIO Housing Investment Trust is focused on high credit quality, multifamily securities, generally permanent construction mortgage-backed securities. And the Housing Investment Trust managers focus on identifying newly originated multifamily securities, just so they can negotiate terms, as well as so that they can ensure that the construction is done with 100% union labor. And again, only pension funds and labor organizations are eligible to invest with the Housing Investment Trust. This diagram shows a bit of kind of the thought process behind the AFL-CIO, how they see their investments through the Housing Investment Trust, not only generating appropriate risk-adjusted returns, but benefiting stakeholders, including union jobs. So first, the pension funds will provide their capital to the Housing Investment Trust. Housing Investment Trust will then finance projects through these securities. The securities help provide competitive returns back to the Housing Investment Trust. With the capital, the construction projects can then be financed while ensuring that it's supporting 100% union jobs. With increased support to union jobs, there's more contributions to pension funds, given there's more work for union labor, as well as there's an increase to the underlying tax base of the community where the construction projects are located. And with a greater tax base, there's easier contributions to the pension funds. And so the cycle itself repeats. And then lastly, some emerging trends to watch. We talked a little bit earlier about the UN Sustainable Development Goals. And I think the key point here is that there's a huge capital gap in $2.5 trillion estimated annually needed to meet the global goals by 2030. And there's a strong belief that market-based solutions are part of addressing that challenge. And so we expect moving forward that there will be a number of attractive investment opportunities for pension funds to invest in that are based on business models that seek to tackle some of these global challenges. Another important piece or emerging trend is there's increasingly more and more available data on impact investments, particularly around financial performance. This is a recent report that was published by the GIN that looks at financial performance of impact investments across asset classes. So as more data information becomes available, it should be that much easier for pension funds to consider how impact investments may fit into their strategy. And then lastly, we've seen the entrance of many mainstream players into impact investing. The market has been developing and evolving over the last 10, 11 years since the term impact investing was coined. But now, as we're seeing these big players enter the market, they're bringing institutional quality funds and other opportunities to the marketplace And this enables pension funds to be able to participate, whereas they might not have been able to do so before due to transaction costs for making smaller investments. So in the case of the TPG Rise Fund, this is a $2 billion fund. Bain Capital Double Impact Fund, this is a $500 million fund. So appropriate size for pension funds to invest in. Both of these funds do have pension fund investors behind both of them. So we expect to see more mainstream players enter into impact investment, and this increase the number of opportunities available for pension funds. And lastly, to end, just places where you can learn more and gather more information. A couple of the handouts as part of this webinar point to our research on economically targeted investments, both the report we published as well as the online catalog of pension fund ETIs, and a note on ETIs from the Initiative for Responsible Investment at Harvard University, their trustee leadership forum that outlines steps that trustees can take to explore impact investments. And as far as thinking through fiduciary duty related to these impact investments, UNPRI has assembled a number of great resources related to fiduciary duty in the 21st century, and will continue to be updating that as the legal body of law kind of evolves over time. And then the last resource is the Global Impact Investing Network's Initiative for Institutional Impact Investment. And this is a place where pension funds, other institutional investors can go to be part of a community of practice to understand how their peers are exploring or approaching impact investments. So it's a great place to essentially learn more and to know that there's others who are in your same boat exploring these opportunities and trying to think through it within their fiduciary lens. And so with that, that concludes my presentation. Look forward to your questions. Thank you.
Yes, when you have control of the microphone, you have to actually turn it on. Thanks very much, Tom. And we will turn over now to Garth Davis. And Garth is a managing partner of New Market Funds and has spent more than 20 years in capital deployment. He has leadership experience in impact investing, private equity, and corporate and leveraged finance. And as a founding member of several initiatives, he's also developed significant startup and growth expertise. Garth has extensive experience in serving as a director on private and public company boards. So please take it away, Garth.
Thank you, Elizabeth. Maybe just a bit about New Markets, because most of you probably don't know who we are. So we're a small, emerging multi-fund manager focused in the impact investing space here in Vancouver and Toronto. We have about 65 million under management, mainly from institutions, no pensions, but banks, insurance companies, credit unions, foundations, and family offices. And we have a team of about 10 split between 2 offices, and it's a pretty unique multidisciplinary team in terms of its experience in community finance as well as more conventional alternative investment and capital markets. This is going to follow somewhat on some of the themes that were raised by both Tom and Sean. The way we look at investments and impact is all investments have impact. And I think that's, as Tom alluded, Sean alluded, that's the direction where the PRI is going as well, and where institutional investors will follow. Whether it's direct or indirect, whether it's positive or negative, things have to be taken into consideration. Impact investing, I think you will see it as a fluid definition. I think Sean highlighted the key parts of it, but what we're starting to see out of the real leaders, and these include global institutions and pension funds, is that they are starting to kind of line up with the UN SDGs and thinking about how they're approaching their entire investment portfolios. And, so some of these would be the real leading Dutch and Swedish pension funds. I think there's over $4 trillion in Europe that has been committed to at least start to try and line up in terms of financial investments and the SDGs. So how does this break down? And why are they doing this? Tom, you alluded to a $2.5 trillion opportunity, and I think that's really just around these kind of 4 sectors that link the market opportunity to the global goals: food and agriculture, cities, energy and materials, and health and well-being. There are a lot of opportunities that you could look at across this, and I think there are a lot of investable opportunities, here in Canada, in North America, and globally. I've highlighted 3 that our work tends to touch on in affordable housing, building efficiency, and building resilient cities. Our housing fund sits, if you think about it from an asset class perspective, as something that is, a bit higher risk than fixed income, lower risk than most conventional real estate, and I'd say commensurate risk-adjusted returns for the type of investing that we're doing. And in fact, if you ever want to go through it in detail with me, I think we can get you comfortable with the risk that we take. So our housing fund, and I'll just highlight from a disclaimer point, this is not a solicitation for investments in the fund. We're actually not accepting capital in the fund right now. But just to give you an idea of kind of what kind of investing is happening here in Canada that could line up with the SDGs. So we focus solely on purpose-built rental that's stabilized, it's multifamily, and we work in partnership with nonprofit and co-op operators, and that's really around maintaining long-term affordability. The segment we work in large metropolitan markets, and we target to be affordable to households earning 80% or below of the area median income. We take a trade-off approach to risk-adjusted returns. We cap our upside in order to maintain affordability, but in return for capping our upside, we get a whole lot of downside protection. And so for investors looking at brand new multifamily buildings in markets like Vancouver and Toronto, a targeted 4% cash return with an overall 6% return is actually quite competitive. And in terms of our exits, we're always targeting to get out in kind of an 8 to 10 year period, selling to our nonprofit or co-op partner, and that really locks up long-term affordability. So why are we doing this? I won't spend too much time on this. I think those of you in Canada, particularly in Toronto and Vancouver, know how housing prices and rent growth has completely uncoupled from income growth in at least the larger Canadian cities, making affordability a challenge. There is in the large cities, there's a crisis of affordable housing that affects members of society all the way from shelters and supportive housing all the way through the rental market up into the ownership market. We chose to focus specifically on the purpose-built rental market. This was the place where we saw kind of the greatest need and the greatest opportunity for us to bring new, what I'd say, market-based capital to become part of the solutions in creating affordability in partnership with government and in partnership with the social sector. So we have a unique approach. Don't really see anybody else doing this, and it gives us a chance to bring investment opportunities to the table for investors that they're otherwise not getting. So we work in partnership with these nonprofits, help them with deal formation. They may already have land, or we can help them secure available land from municipalities or other groups. And that land comes basically at no value or no cost in exchange for long-term affordability restrictions. We'll give them a commitment for post-construction stabilized equity. This helps them get their construction financing to get the project going. We only invest once it's fully rented up, fully stabilized, and producing regular cash income. Our nonprofit partner that has an existing portfolio manages the property. And as I said, we do a structured sale to them on the back end to help us get our exit. And some of the key ways that we mitigate risk, and Sean, you highlighted there's a lot of concern. It's the right conversation to have around risk and around new kinds of investments. And so this is one of the areas that we definitely focus on. So the ways that we kind of mitigate our risk for our investors is we only invest in brand new stabilized buildings. So we don't expose our investors to any development, construction, renovation, or repositioning risk. We focus on only the very largest markets, so we're not coming into a small market and potentially putting too much product on the market. We have a priority of return on and of capital, and this reduces our downside risk. So typically in these deals, there's about a third of the capital that's coming in, what I'll call it's affordability first capital. So it might be coming in from the municipality, the province, the federal government, the co-op or nonprofit sector, or even philanthropic interests, and that capital is subordinated to us. And so we sit right behind the first mortgage. And these properties, because of the significant affordability versus market rents, are typically at a 30% plus discount to market rents for comparable units. We have a dramatically reduced vacancy risk, and this helps to kind of insulate our investments to the degree that whether there's a recession or whether the market gets overbuilt or there is increasing vacancy, these would be some of the last units to sit empty because they're brand new and they're at a fairly significant discount to market. And then in terms of liquidity risk, we've set these things up really to be self-exiting between the cash flow that they generate and the ability of the property to do a conventional mortgage refinancing 8 to 10 years out. Here's just a few examples of some of the early commitments we made on the fund. These are here in Vancouver in partnership with the Vancouver Community Land Trust, where the city provided the underlying land, the province made a small contribution, the co-ops and nonprofits put in some capital, and then we sit atop that stack, and the only money that is ahead of us is the mortgage. And give you an idea, so it's mixed use, it's all mixed income, low-rise townhouses, high-rise. Typically in neighborhoods that are either have space available for development or that are undergoing increased density. So some examples of our work. Thank you.
All right, thank you very much for that, Garth. You're spot on time. So we have a little bit of time for questions from our panelists. Understand that some of you will be needing to leave us because you've only allocated the 45 minutes, but if you are prepared to stay with us, we can ask a couple of questions. I have one from, oh, sorry, I just need to scroll back on that, from Ian for Sean. Thanks for your presentation, Sean, but I'm still not clear about the difference between impact investing and PRI. Can you have PRI investment without impact investment or vice versa? So that is for Sean.
Yeah, I think that's an excellent question and understandable. In terms of ESG integration, I think it's all about process and intent. As was stated earlier, all investments have an impact, but it's the way you set out your policies and procedures that makes the difference. So if you set out to say, well, we want to have a demonstrated impact flowing from our investment, that narrows the field of your investment horizon, as opposed to general ESG integration. If you're looking at ESG integration, you can go to various mutual funds and invest in them, and different kinds of products are out there now. There are new ones every day, and they don't necessarily demonstrate to you a measurable impact. You have a sense that there are criteria and whatnot in place to ensure that ESG-related risks have been taken into account, but it's more a focus on the risk that ESG factors play, as opposed to a positive intent to foster or generate the impact. I don't know if that helps with the distinction.
Okay, thank you very much. Thanks. We have another question for how is it possible to achieve reasonable returns with ETIs? Are there certain guarantees offered to ensure certain levels of return? And it looks like that is a fairly general one, so why don't we start with Tom on that one?
Sure, happy to chime in. It's a great question. I think the piece about ETIs related to investment returns is, you do due diligence on a potential ETI. You really interrogate the investment thesis in the exact same way that you would approach any traditional investment. So I think that's the way that you do your best to ensure reasonable returns, is you treat an ETI, and even we're seeing with impact investments in terms of the pension funds I mentioned that are investing with the Bains of the world or TPG Rise. They're approaching these investments just like they would any traditional investment, and are focused on the underlying financial mechanics of the deal as part of their due diligence. So I think that's really the key.
Okay, thank you. And I've got a specific question to Garth, so I'm going to go to Sean for another try at this question, and then we will, if you don't mind, we'll go to Garth for this specific question to him. So Sean?
In terms of guarantees, I don't know of any. I think people who are marketing these products may start to think about that in terms of making it more palatable. I don't know who the backer of that guarantee might be, but I'm on the same page in terms of due diligence on these investments. I think that's your best bet, is to understand that past returns don't necessarily guarantee future returns. All of the standard due diligence questions you would ask. And at the end of the day, what security is there for a worst case scenario? So in terms of real estate investments, there is the foreclosure option. What is the underlying land value? Can it be executed upon? I know it sounds mercenary, but I think one has to think about the worst case scenario and what kind of creditor remedies are available with any of these kinds of investments.
Okay, thank you. So Garth, you may want to chime in on this one as well if you have something additional, but the question specifically to you is, where do you expect new market funds to be in 5 years, and do pension funds have a place in its future?
It's a great question. So, our first fund was 25 million, and we'll do about 750 units out of that fund. Right now, we're sitting on partnerships moving forward on about 1,400 units. So that would imply about another 50 million of need. And then we've got about another 1,400 units a couple of years behind that in terms of development. So, I would hope that, in that 5-year time horizon, we'd be getting to, a scale on the housing side where we're, approaching $100 million funds. I think probably our next one might be like 50 million. So it's not going to fit if your minimum investment is 100 million and you can't be 10% of a fund. But if you can be 10% of a fund and you're willing to do 5 million and with us along the way, there could be an opportunity. I mean, I think that the piece, and this does link back to the earlier, kind of question around ESG and impact investing, is, as pension trustees, and I'm a foundation trustee, but not a pension trustee wearing a separate cap, is we have to look at the kind of real estate investing we're doing and what it's actually doing to the long-term, kind of livelihood and viability of life of our pension beneficiaries. And if you're investing in multifamily real estate in Vancouver or Toronto, I'd say, frankly, it's part of the problem that asset, that Maslow's basic need, housing, has been turned into an asset class, and with every transaction that crosses between big players, either directly or using conventional fund managers, we're pushing up the prices, and we're challenging the affordability further. And so, hopefully down the road we'll have the scale to be able to provide an alternative for pension funds to invest in real estate in a more responsible way.
All right, thank you very much. So this will probably be our last question. It's to all the panel members. And and just in the interest of rotating it and arbitrarily, I'm going to go to Sean, Tom, and then Garth. So what are some of the metrics that you use to quantify the impact of your investments? Would this be standardized, or do various impact investors use various metrics? So let's start with Sean.
Wow. Well, that's part of the challenge of this area. Exactly how do you measure these social impacts? And I think when you look at the Sustainable Development Goals, you probably are going to want to harness the evolution of fulfillment of those goals as one indicator. But I think all of the products out there in terms of marketing and impact investment strategy will want to think about that. There's various ways and means of doing that. I suppose, one is clearly articulating what the expected impact is, and right up front, defining what the key performance indicators will be. And again, I think I go back to the people who put the products together to think long and hard about how they're going to be able to demonstrate that. Excellent question. And it's part of the evolution of ESG and now impact investing for sure, is how are we going to measure these things?
Okay, thanks very much. Tom.
Sure. Yeah, I'm glad that the impact measurement question came up, because this is really a key facet of what makes impact investments impactful. And this is something that we do. We provide consulting services related to impact measurement and management. And so in terms of the question around standardized metrics, the Global Impact Investing Network has a catalog of metrics that the industry has sourced in hopes of creating more standardized measures around impact. It's called IRIS, Impact Reporting Investment Standards. So I'd encourage folks to take a look at that resource. And there definitely is a move and desire for more folks to focus on standardized metrics. And another project out of Bridges Fund Management called the Impact Management Project is also seeking to really highlight how investors should be measuring impact and what kind of the conventions or norms are for the practice as part of creating more standardization. They've identified 5 dimensions, and you can think of them as 5 questions that you should be asking yourself as you're seeking to understand impact. They focus on what, how much, who, contribution, and risk in relation to impact. Again, you can find more of that at impactmanagement.com. But in terms of like the work that we did with CalPERS on their economically targeted investment, the California initiative was focused on supporting businesses in underserved communities and was focused on job creation. So we tracked at the individual portfolio company level the jobs that were created, whether they're part-time, full-time, the wages that were being paid to employees, the types of benefits that were being provided to employees to understand if these were high-quality jobs, the location of these investments to understand if they were indeed in underserved communities across California where institutional equity capital not been previously. And so we designed the reporting around the ultimate goals of that particular ETI. And that's the way that most impact investors approach this question. Is you would identify the right set of standardized metrics based on your impact goals or objectives at the outset, and then have your measurement and reporting built into that over time to give you the information you need to know if you're meeting your objectives.
Okay, thanks. And the final word to Garth.
Sure, thanks. So for new market, Tom, it's great. Thanks for mentioning IRIS. So we have embedded in our partnership documents that we're an IRIS filer for the affordable housing and community facilities metrics. It makes it very simple. They are set out. It is something that is evolving. They're changing, and the standards will change, and we will continue to change with the standards. But our investors know exactly what they're going to get. They knew it on the front end. They'll get it along the way, and they'll have it at the very end to demonstrate to their stakeholders what the impact was of their investment.
All right, with that, then we are at 1:56 Mountain. No, sorry, that's Eastern Daylight Time. Thank you very much, gentlemen, for this. Sean Hatch, Tom Wolfe, and Garth Davis. I'm sure our participants have found this useful. I'm sure we're going to have lots more conversations about these types of investments for our pension plans. This then concludes our 5 sessions, our 5 webinars for NUPGE. I'm hoping that you found them useful, and we very much thank everyone for joining us for these webinars. And finally, without the assistance of SHARE, we would, and particularly Tamara Herman, notwithstanding we had some issues this morning, these would not have been possible. So thank you very much, Tamara, Peter, and everyone else at SHARE. With that, signing off, thank you very much.